Okay, in this video we're going to be looking at how inflation can hurt living standards because of its impact on interest rates, on investment spending, and on our international competitiveness. So the first one is, with our international competitiveness, and this is probably one of the more straightforward impacts of inflation, is that exporters and import competing firms, so Australian firms that are competing against imports from overseas, are likely to lose sales and market share. So exporters will suffer because they will be able to sell less overseas because the price is higher. Australian import competing firms will suffer because we import more. This will lead to a decrease in net exports, exports minus imports, lead to reduced profits for businesses and reduced national incomes. This can flow on to the fact that more Australian businesses will start closing down, structural unemployment will increase, and again that will have flow-on effects for reducing people's income, reducing people's purchasing power and their material living standards. So export and import competing firms will lose sales and market share, decrease net exports, lower profits, higher structural unemployment as businesses close down, and that flows on to reduced aggregate demand, reduced real GDP, and it can also cause higher trade deficits because the imports minus exports increases, so that can hurt our current account deficit. The only people that would benefit are people that are importing products from overseas, because then they'll be cheaper than the ones that are trying to compete against Australian businesses that are selling them themselves because inflation's higher in Australia. So importers benefit, but everybody else in the trade industries will suffer. The second reason is that inflation undermines business confidence and economic growth. And what I mean by that is businesses are likely to experience reduced business confidence when inflation's high because they're not sure that their future investments will be viable. Because inflation and prices are increasing, they're becoming less competitive, and that can flow through to them not feeling like they're likely to make a profit on future investments. So that can lead to the abolishment of investment projects. It can lead to them abandoning the investing projects because they don't think they're going to be profitable, and that leads to reduced economic growth within the country as well. So it can undermine business and consumer confidence, reduce investment spending, and that leads to problems in the future because we're not as productive, we haven't got the resources that we haven't invested in capital and machinery, and that can have negative implications for our economy. Businesses also don't want to invest because they know that interest rates are likely to rise when inflation's high, and that makes their projects more expensive to service. Okay, another problem. So we've talked about how it hurts international competitiveness. We've talked about how it hurts business investment because of a lack of business confidence. Another reason why it hurts growth is because it leads to higher interest rates. And there's two reasons why inflation leads to higher interest rates. One, the banks are greedy and need to protect their margins. And two, they want to increase interest rates to slow down inflation. So firstly, banks need to maintain what we call their real rates of return. So what that means is if they lend you money at, say, 5% interest rates, but inflation's at 3%, then they're really only making a 2% increase on that investment. So when inflation increases, so let's say if interest rates are at 10% and inflation's at 2%, the real interest rate, the interest rate after taking into account inflation, is at 8%. If inflation increases from 2 to 5%, to maintain their real interest rate or to maintain their real rate of return, they need to raise their rates to 13%. So banks will need to increase their interest rates to maintain their real rates of return, and that's one reason why interest rates go up. The second reason is that banks will increase interest rates to slow the level of inflation. Higher interest rates will slow down spending and therefore help to reduce the level of aggregate demand and inflation. Now the problem with this, and this isn't new, this will decrease people's discretionary incomes, reduce the incentive to borrow, which can lead to reduced consumption and investment in the economy, decrease aggregate demand and reduce economic growth and living standards. So this can flow through to decreased discretionary incomes, reduced borrowing, reduced consumption and investment. Two reasons: protect their real rates of return. Secondly, to make sure that we help to control inflation. Higher interest rates are bad. The other thing that interest rates can occur is what we call a wage price spiral. And this is bad because it increases firms' production costs. So what basically happens is inflation increases. Then because inflation increases, people's real wages have fallen because their prices are more expensive and their wages the same. So they then demand a higher nominal wage to protect their real wage. So they demand an increase of 3% to keep up with inflation. And because they've increased their wages, businesses now experience higher costs of production. Because businesses are experiencing higher costs of production, they need to increase their prices to maintain their profits. When they increase their prices again, business people will demand higher wages. When people demand higher wages, that will lead to higher cost of production. They'll raise their prices again, and we keep going round and round in circles. So it's called a wage price spiral because higher inflation leads to people demanding a higher wage, which leads to higher production costs, which leads to higher prices, and we keep going round and round in circles. It's not as prominent today because a lot of wages now are based on enterprise bargaining and productivity agreements, so it's not as big an issue today, but it's still a problem that can occur in the market. So one problem is the wage price spiral, and that's just a wage price spiral there. We have inflation, people demand higher wages or higher nominal wages to protect their real wage. This leads to increased consumer spending, but also leads to higher cost of production. Inflation occurs again, and we go round and round in circles. Okay, two other impacts that inflation can have is the impacts that it can have on equity and external stability. Inflation is really bad for equity, and there's two reasons for that. One, high inflation leads to increased unemployment, which means more people are living on transfer income. So more people are living on like $250, $260 a week for New Start allowance. That leads to more people living in poverty and being unable to afford a dignified standard of living. So we've got a bigger Gini coefficient because we've got more low-income earners in the economy and they've got a smaller percentage of the wealth. Many low-income groups with little bargaining power find it hard to increase their wages, so that's another reason. So there's more unemployment, but it also hurts low-income earners more because they find it really hard to increase their wages in line with inflation. So again, we have a bigger gap between the rich and the poor. Low-income earners have a greater propensity to spend as well, so they suffer again because their purchasing power is reduced. High-income earners are more likely to put their money into different forms of investment that allow them to make money, so they might put their money into certain assets which generally increase in price in line with inflation. So to summarise, low-income earners suffer because they're more likely to be unemployed, they suffer because they have weaker bargaining power, and they also suffer because they're more likely to spend their money, whereas high-income earners are more likely to put it into investments that generally go up in line with inflation. And finally, external stability. External stability is really bad, inflation is really bad for external stability because it erodes our international competitiveness. We will see decreased demand for Australian exports, and that will lead to an increase in the balance of goods and services deficit. So that's just the difference between the total value of exports and imports. And that can be bad because it increases our current account deficit, which flows on to increased net foreign debt. So it erodes our international competitiveness, that hurts the demand for Australian exports, and increases our current account deficit and net foreign debt. This can have negative implications in the long term for the Australian dollar as well, because we have to service our debt and have to pay a lot of currency back, which means there's more supply of the Australian dollar. And finally, inflation can be a self-fulfilling prediction. And what I mean by that is, and this is a little bit different, this is a bit off topic, but inflation can cause itself. So if consumers and businesses think that inflation is going to occur or prices are going to go up, then they demand higher wages. When they demand higher wages, that leads to higher prices, and then that leads to inflation in the future. So what I mean by that is, so I'll just say that again, I didn't say that very well. Consumers predict inflation is going to occur. They think prices are going to go up, and therefore they do two things. They spend more now. They spend more now because they think prices are going to go up. If something's $10 and you think it's going to go up to $15, you want to spend money on it or buy it before the price goes up. Workers, on the other side, they demand higher wages because they need to be compensated. So there's more spending in the economy, there's higher wages, and that leads to inflation in itself. So if people think inflation is going to occur, they spend more, and then that creates its own inflation. Thank you.